So a question states that the trial balance of OK, a sole trader at the end of the first December 2003 is given below. So the trial balance comes. Please can you hear me?
Yes.
Okay. So the trial balance.
Yes.
Now you can see that on the trial balance some we have two currency signs. We have two currency
We
signs.
have two words.
Currency signs.
Yes.
Good. Now, and the first item is capital. So now the first currency sign is debit, and the second one is credit. Please, can you guys mute yourself because I think there is some feedback coming from your end. If you don't understand something, you can raise your hand. If I don't see you, you can unmute yourself. Then you talk. Okay. Hello. Good.
Yeah,
All
we
right.
yeah, so we just muted ourselves. So
All right. All right. I just saw it. Now, all the items on the debit side are either assets or expenses, and that of the credits, they are either capital, income, or liabilities. Please you understand. Another thing you should know about the trial balance is that everything in the trial balance has passed through the double entry system. For that matter, or for that reason, it will be treated once. Every item in the trial balance will be treated once because it has already passed through the double entry system. So if it is income, and we all know that income is revenues or what we call sales or gains, that's other income. So if it is income or expenses, they will be treated, these two will be treated in the income statement. And according to the matching concept, it says that to get your profits, we should match all our expenses against our income. We did matching concepts. So that's the same application we are coming to do here. Okay. Now, so if we are treating
tell him to off that.
if you are treating income and expenses in the income statement, if you are treating these two in the income statement, then it means that the remaining, which is our assets, capital, and liabilities, will be treated in the statement of financial position. And you know that our assets can be, an asset is any resource that is controlled by a business in order to generate future economic benefits. And we said that assets can be non-current assets or current assets. So non-current assets are assets whose lifespan exceeds one accounting period, like the buildings, the land, the motor vehicles, the machineries, the furniture and fittings and the rest. Now, current assets are assets whose lifespan are within one accounting period. And these are the cash we have in the business, the receivables, the expenses prepaid, and the income owings, and the rest. Okay, these are all current assets. And I told you that capital has its components. And I said capital is the opening capital, that's the one in the trial balance. Then any profit we get, that's any net profits we get from the income statement, we bring it here. Then if there are drawings, we subtract, and that will give us capital. Now, liabilities are the amount of money the business owes to outsiders. So, therefore, liabilities too can be, oh, where is it? Okay, non-current liabilities or current liabilities. And non-current liabilities are the liabilities that are within one accounting period. Sorry, that are more than one accounting period, or its maturity date exceeds one accounting period. And current liabilities are liabilities whose maturity dates are within one accounting period. Please, do you understand? So this is how we are going to prepare our statement of financial position. So we first start with our non-current assets. We move to our current assets. Then we say that we are done with the first side, which should be equal to the right side. So the asset side should be equal to the capital plus liability side. So we move to the other side, say finance by capital. So we bring the opening capital, we add our profits, we less one, and we say add non-current assets because it's addition. You can see it here. So we add, then we add current assets. Then whatever we get here from adding from year to year should be equal to this and that. Please, you understand?
Okay.
Good. So this is what basically we are coming to do. So without wasting my time, let's start. Let's go through the question. Now, let me see if I can project the question. Okay, so I'm going through the question with you guys. It says that the trial balance of OK, a sole trader at 31st December 2003 is given below. So this is the trial balance. I told you that everything on the debit is either assets or expenses, and everything on the credit is either capital, liabilities, and income. So we are not interested in the trial balance because you should know that anything in the trial balance will be treated once, some in the income statement and the rest in the statements of financial position. And I told you that the ones that we are treating in the income statements are incomes and expenses. And what I mean by income is revenues and gains. And expenses is a cost that has been consumed. So anything that is a cost that has been consumed is an expense. So you should know that. Now, what I'm interested in is the additional information because that one has not yet passed through the double entry process. So we will treat those ones twice. Okay, so always when you are tackling your question like this, you have to first take the income statements. Sorry, the additional information to it. Okay, so the additional information to the question is most important. When you are able to do those ones, which means the question will be the rest will be just a format. Okay, so let
Hello, Paul.
Mr. Donda.
Hello.
Yes, please. I'm
Yeah,
listening.
I think Senna is trying to join, but
Okay, so what I'm saying is that everything in the additional information will be treated twice. And that should be our focus because that one has not yet passed through the double entry. And double entry means double entry, the dual concept. Every transaction should be treated twice. Please mind you, everything we are coming to do here is based on our knowledge on accounting concepts. And I believe now everybody understands the concept. Whether you can't put it verbatim, you should understand it. Okay. Okay, so I'm starting now. It says that you are also given the following additional information, and the first one is saying that the rent for the premises was agreed at 300 cedis per month. So this means that you can see rent in the trial balance, right? Rent for premises 3,140, and they are telling you that 1 month there, every 1 month is 300 cedis. So you would have to multiply 300 cedis times 12 to know a full year's rent. And if it is 3,140, then we say that yes, that's it. But if it is more or less, we have to adjust. Please, you understand? Now, the second one says that a sum of 200 cedis is still due to be paid for general expenses. Now, due means owing. It means that they are owing general expenses of 200 cedis. The accrual concept comes in. Accrual concept says that we should add owings, we should let prepaids. So this owing will be added to the general expenses and also treat it as what? An expenses owing, which is a liability. Now, the third one is saying that the bank loan was taken out on the 1st July 2003. So they took the bank loan on the 1st July 2003. You can see 10% bank loan, 10,000. And they are telling you that they took the loan on the 1st July 2003. It means that it was just half a year's loan that was incurred that year. It is not the full year. Please, are you getting it? Now, the fourth one says that it is the policy of the bank to pay 14% interest on all deposit accounts. So, let me see. Were there any bank? Okay. So, let's go to the next additional information. We'll treat that one too. And the fifth one is saying that Mr. Edem, a customer who owed OK 200 cedis, was declared bankrupt by the court, and OK debt decided to write off his amount as bad debt. So bad debt will be treated. And I told you that when bad debt is in the additional information, you treat it twice. The first thing is that you treat it as an expense. So if there is an existing bad debt, you add it to it. If not, then you still treat it as bad debt. Then also you less it from the receivables account. Now, the sixth one is saying that depreciation is calculated at a rate of 5% on building and 10% on furniture and fittings. And the seventh additional information is saying that stock as at 31st December 2003 was 4,580. So that's the closing stock, closing inventory. Okay. Please, do you have any question? Am I being fast or slow, or it's normal?
It's okay.
We are listening. Maybe when you start calculating on the board, then we'll start. I will be asking questions. For now, we are listening.
But am I being fast in talking?
It's fine.
Okay. So we are starting. Okay. Okay, what? So okay limited, or maybe okay in the books of okay, any which way you say. Please always start with your notes or your workings, or you can decide to start with the work itself. But the best way to do it is when you do your workings. When you do your workings, it makes the work easier. Okay. So let me do the workings first. Because I said when I do the workings, it makes the work easy. Okay. Now, workings number one on note one, any which way. The first workings is on rent rents. Now, the rent in the trial balance, so as per TB, is what? 3,140. Now, they said that the monthly rent is 300 cedis. So, to get 12 months rent, it becomes the 300 times 12. And please, what's 300 times 12?
Hello. Sorry to bother you again. Some other people are also trying to join, Officer and Dinah, but you need to
Okay.
accept them. Yeah.
So, like I said, so the rent for 12 months becomes 300 times 12, which is 3,600. So this is the rent incurred. This 3,600 is the rent incurred. Okay. But this is what was paid. The one in the trial balance, it is what is paid. Now, it means that they are owing rent of what? 3,600 minus 3,140 is what? 460. Okay, so this becomes rent owing, and that owing should be added back to what was paid to get the incurred. So what we recognize in the income statement is the incurred. This will go into the income statement, and the owing will be treated as a current liability. Please, do you understand? This is the first additional information. If you have any question, you can ask. Number two,
If you can go all over again, I will appreciate it.
I've heard. Now I'm saying that the rent in the trial balance is what was paid, but the accrual concept states that you should recognize expenses when they are incurred and not when cash has been paid for it. So we look at the incurred, not the paid. And they are telling you that rent for a month is 300 cedis. You know that for a year will be what? 12 months. So 300 times 12, which is what? 3,600. Oh, where's man? Which is this? 3,600. But this is what has been paid. So it means that they have to top up the difference between 3,600 and 3,140, which is 460. You have to pay it back. So that 460 is rent owing, and we treat it as a liability. But when we are recognizing rent in the income statement, we have to recognize the full amount of rent incurred, the full 12 months rent, because we are preparing the income statement for a 12-month period. Please, you understand?
Yes.
Okay. Please, any question on that one? Okay. So the general expenses too will bring as per the trial balance. And I think general expenses as per trial balance. Let me go to professional. See, general expenses as per trial balance. Hey, I can't see it. Please, have you seen it? This is not the question.
That's the second one. A sum of 200 is still due to be paid for general expenses.
Yeah, so this is the question actually. So the general expenses as per trial balance. So general trade expenses is 1,400. I believe you can see it. So that 1,400 will come here. Then we add the owing, because I told you that the question is saying that we should add owing. We should always add owing. So the owing is what? 200. So when we add the owing, we get 1,600 as incurred. And this will come into the income statement. And this will go into the owing, will go into the statement of financial position as a current liability. Please, you understand? If you don't understand, let me know. Third, additional information. Bank loan. This bank loan will have no effect on it, but the interest rather would have an effect, because interest on bank loan is always treated as a period cost. And a period cost, we are looking at 12 months interest. Okay. But look at the question. The question says that we took the loan. It says that the bank loan was taken out on the 1st of July 2003. So we took it for on the 1st July 2003, and we are reporting on the 31st December 2003. So from 1st July 2003 and to 31st December 2003, it's just 6 months. It's just 6 months. So it's not a full year, it's half of a year. So we will find interest on the loan. Interest on the loan. This one is more of quantity. Okay. Interest on loan. So this becomes 10% on the loan amount. The reason why I'm saying 10% is because you can see it. It says 10% bank loan. So the 10% becomes the effective interest rate. And the loan amount is 10,000. Okay. The 10% is the coupon rate. However, it becomes the if it is the coupon rate. Yes, it is the coupon rate. So that's what we use it in calculating. So the 10% times 1,000, then we multiply it by 6 divided by 12. And I believe we know why it is 6 over 12. Because we are dealing with only 6 months out of 12 months. So 10% over 6 over 12, 10% of 10,000 times 6 on 12 becomes 500 Ghana cedi. 500. Now, please, you can see that there is no interest on loan in the trial balance. There is nothing like interest on loan in the trial balance. So it means that none of the interest has been paid yet. That's why it has not passed through the double entry. So you do a double entry yourself, and this becomes you debit income statement.
Please,
Let
we
me
are getting a feedback. I don't know if it's from your keyboard or something.
really
Like a scratch. I don't know if the others are hearing it, but it's like a scratch.
debit income statement. Do you still hear it? 500. Then you
Yes.
credit the statement of financial position as a current liability, 500. You still hear it?
Yes.
If it comes, you guys should do justice. Now, the fourth one says that a customer who owned OK 200 cities was declared bankrupt by the courts, and OK decided to write off his amount as bad debt. So there is a customer, which is Mr. Eden. So Mr. Eden is in receivables. Okay, Mr. Eden is in receivables. Okay, let me wait and see that. That's what it's for. So receivables. Okay. Now, so we take the balance as per tribal. The receivables figure as per tribal. So receivables figure as per tribal. Trade receivable or debtors. Okay. Yeah, it is debtors or credit. So the debtors is the asset, so it's debits. The 7,500 becomes the receivables, where the creditors become the liabilities. So that one becomes the payout. So the receivables figure is 7,500. Okay, this is what people are owing, which includes Mr. Oka or Mr. Eden. Sorry, Mr. Eden. Mr. Eden also owes you that amount of money, and we said that Mr. Adams' amount is included in this 7,500. We are saying that Mr. Adam has been declared bankrupt, so which means he can't pay that debt. So if he can't pay it, you have to write it off by subtracting it from the receivable and treating it as an expense. So this becomes the net receivable. So the double entry is debit expense with the 200 and you credit receivable, which we've already done by subtracting the that's each one. Anytime you are crediting an asset, it means that you are reducing the asset. So the receivables was 7,500. So since we've credited receivables, that's why I subtracted 200. So I've already done that, but I'm just teaching you the top one. Okay. So this is how it works. Okay. Now let's see additional information. Oh, this is five, right? Ah, oh, okay, I didn't do four. Okay, let's do additional information four. So let me do it as my question. Five. Interest on all the please, I believe you've seen that one. The last additional information says that it is the policy of the bank to pay 14% on all deposit accounts. So it is the bank's policy, the bank that you are depositing the debt, to pay 14% on all deposit accounts. So you go to the additional information, you see fixed deposit. was 5,000. This is it in the question. Balance at fixed deposit 5,000 from the debit. So which means it is an asset. Okay. Now you have given your money 5,000 cedis to the bank, and the bank is supposed to pay you interest on it. And they have agreed to pay 14% interest on all deposits. But yet there was no timing. Unlike the loan, you see the loan they brought a time. But yet they didn't bring any timing. So the you don't subject it to timing, you assume a full year. Okay. So since there was no time, say that interest on fixed deposit or deposit becomes 14% of the 5,000. Even wasn't necessary, right? And 14% of the 5,000 comes with 700. Hello,
Hi.
this are you understanding?
We are following for now.
Eh, okay. So now listen. This is you deposited 5,000 in the month. Okay, and the bank agreed to pay you 14% interest on the 5,000. They mean that your total amount is 5,000 plus the 700, which is a gain. You gain from your deposit. Okay. So when you add, you get what 5,700. So this is how it becomes. So the interest on this deposit, the double entry of the 700 becomes debit current assets or debit your current assets with the 700, which is your interest on deposit. Then you credit your income statements. You see, I told you that, this is a gain. I said it's a gain. Okay. And I told you that income is what revenues plus gains. So here it will be treated as other income in the income statement as 7. Please you understand?
Okay.
Yeah. I think it's left with two more additional information. That's preparing that. Oh, one more. That's depreciation. The stock, that one when we are preparing it. Now, depreciation. So let me do it working in 6. So depreciation. Now, you think that depreciation is calculated at the rate of 5% on building and at 10% on furniture and fittings. So when they say that now depreciation we have two methods so far as your level is concerned. So when they say that it is either we are going to use the straight line method or the reducing balance. But if the question is silent on which method you should use, please use the straight line method. Now, the question can say use the straight line method or use the reducing balance method. That's it not being silent. Another way of saying use the straight line method is that it should be calculated on the cost. And another way of saying that use the reducing balance method is that it should be calculated on the net book value. Please you understand? Now, I'm saying that with depreciation, it could be either on the straight line or the reducing balance. Now, if they say it should be calculated on the cost, they mean straight line. If they say it should be calculated on the net book value, they mean reducing balance. Another name for net book value is also called carrying amount. That's another name for net book value. Now, this is how we get the net book value. It is equal to your cost minus your accumulated depreciation. Net book value is equal to your cost minus your accumulated depreciation. Okay, so I'm going back to the depreciation. And I'm saying that if the question is silent on it, means it is on straight line. If the question is silent, then it is on straight line. So I'm going back to depreciation. So they said that for motor vehicle, or it's not, oh sorry, for building, the depreciation should be on cost. So 5% of the cost of the building. This was the cost of the
The co-
building. So that's it. 22,000.
Yep. Yes,
22,000. Cost of the
2,000.
building, 22.
And furniture and fittings is 1,200.
Let me write F and F because it's not that one is 10% on 1,000. Okay.
Oh, your screen is gone.
Is there?
Is there, but it's becoming slow.
Yeah, the network. That thing is the network. So please, 5% of 25,000 of 22,000 is 1,000, and also 10% of 1,200 is 1. So when we add both, what do we get? Oh, it's very slow. 1,000. Please hold on. Let me check. Okay. So this becomes the depreciation that was incurred. You see, I told you that expenses is a cost that has been consumed. You see, I said expenses is a cost that has been consumed. So, like a building, for instance, building to when they lose value, that's what we call depreciation. When the building loses small value, we say it has depreciated, and that part of or that loss in value should be expensed because that cost of the building has been consumed. That portion of the building has been used. Please, you understand? So that's the depreciation for you. So without wasting my time, let's go to the main thing. Okay, okay, let me add it, even though it's not a company. In Ghana, everything they add it. So income statement for the year and 31 December 2020. So please, this is how I write. Always, me, I like to use three currency signs for the sake of presentation. It doesn't mean anything. This because it is a statement, it's not an account. Don't say that the first one is debit, the second one is credit. It is not an account to say that. It is just a statement. The reason why I use three currency sign is mostly I know how to prepare it. So I do my adjustment in the income statement. You see the this adjustment we've done. I do mine here. That's why I use three currency signs. So the first one is for adjustment, the second one and the last one is for the root. Even your own, I don't need the three, I just need one or two, then a note to the account. But I've decided to use three so that I'll teach you something. So the first thing we start with is the sales or the revenue. And the sales figure is an income element. I told you that income is equal to sales plus gains or revenues plus gains. Revenue and sales are the same. So income, the sales is a revenue figure. So you go to your trial balance, you look for your sales, and I said it is on the credits. It is on the credit. So your sales is the you see purchases and sales. Even they writing purchases and sales should tell you that purchases is the one on the debit and sales is the one on the credit. But you should know that sales is always on the credit, which is 50,970. Okay, so you take that one, 50,970. Then you less, you see, you sold to people. If you sell goods to people, what you receive is revenues. Okay, so the sales you receive is the money, is the amount of money you received from your ordinary course of business. So you sold some goods or
So,
some
are you not writing the sales at the debit side?
at which debit side?
I thought the first one, I mean the second one is supposed to be debit and the last one will be credit. Or
You see, I that's what I was saying plenty. That it is a statement. That's why we call it income statement or statement of profit or loss. It is not an
okay,
account. For that matter, it does not have debit or credit. It
or
is a
credit. Okay,
statement. I decide on how to present. But
okay,
yes, I decide on how to present it. Okay. So you can put it on the first, but ideally I use a standardized presentation from all the classes I've gone to, be it ICAG and the rest. Always they put it where I'm putting it. That's why I'm putting it
okay.
there. Okay.
All right, understood.
Okay. So the sales is the money you got from whatever you sell. And that thing should be your ordinary course of business. So if OK is selling laptops, this amount of money is the monies he generated from selling laptops. That's the 50,970. Now, returns inwards should be subtracted because